Good afternoon, folks. This is Anthony Mento. I'm your host for today, and we're going to take you through a fast and furious sales presentation. I promise to keep this to a 10 to 12 minute presentation just to whet your appetite, showcase some of the things that we're doing in the fourth quarter of 2015. I'll ask that you mute your lines, and it's a relatively intimate audience, so if you have any questions, just unmute and ask at your leisure. So first and foremost, I wanted to convey that 'tis the season of underwriting, and you will see sizable impaired risk cases go down in the fourth quarter of 2015. We have 3 professional underwriters on our staff who have helped us influence over $4 million of target premium in this current year. So if you have any impaired risk cases, now's the time to get them in front of underwriters, particularly from carriers who are behind or slightly off of goal. Things tend to loosen up at this time of year, the fourth quarter of 2015. One strategy we wanted to share with you is a reduced paid up strategy, and the philosophy here is that 2 policies sometimes work better than 1. And circumstance where a client owns a seasoned whole life policy or universal life policy or variable life policy, it doesn't have to just be whole life, and desires some additional guaranteed life insurance coverage. Clients like the security of cash value, but they don't want to outlay any additional premium to buy that additional guaranteed coverage. So the strategy in this particular case, again, we're utilizing a whole life contract in the case study, is that we'll run an in-force ledger with a whole life carrier as a reduced paid up. We'll compare what the client currently has in their existing whole life contract versus the reduced paid up. We'll complete medical underwriting to determine how much max face amount we can buy utilizing a guaranteed UL contract and the client's current premium outlay. In this particular case, we can purchase an additional $2 million of guaranteed coverage utilizing the same outlay client was allocating towards the whole life contract. So it kind of looks like this. In a simplistic format, we try and bring things back down to a one-page client-friendly presentation where we're explaining in the in-force policy option, the consumer has a whole life contract for $1,097,000, and they have 10 years left, paying $26,470. This was actually a 20-pay whole life contract issued 10 years ago. We go to the existing carrier and we say, okay, we don't want to pay any more premiums into this contract. Tell us how much death benefit we can get on a guaranteed reduced paid up basis, and that $1,097,000 is reduced to $637,319 with no further outlay. Now, if the client is insurable and we can obtain, in this case, a standard risk, we can allocate the expected $26,470 of premium for 10 more years to buy a guaranteed universal life contract for $2 million. So if I look at the total insurance portfolio of the blended policies, we look at increasing the coverage from $1,097,000 to $2.6 million without an additional penny of outlay. Sometimes 2 policies work better than 1. Don't pigeonhole yourself into looking for only whole life contracts. There are significant universal life contracts that can act in the same way, because the universal life contracts typically have very strong accumulation values but very weak surrender values. So to surrender them or 1035 them out puts you at a tremendous disadvantage when they have such exorbitant surrender charges. However, if you put those universal life contracts to sleep, all the policy charges come from the accumulation value, and you can typically purchase a significant death benefit without any further premiums. So don't neglect any universal life contracts that you've written over the past 10 to 15 years. And here's the numerics associated with the client-friendly presentation in the prior slide. And here's the year-by-year, column-by-column numerics, where we can increase death benefit by 140% initially, and at life expectancy by 40%, assuming the whole life contract continued to honor its current dividend yield. Second year-end fast and furious sales idea is advanced age term. What we're finding is that clients age 65 and up who currently own or are exploring a new term contract may be better suited with a permanent product or a term look-alike. We feel that a couple carriers have possibly mispriced universal life contracts where you can enter them very inexpensively and catch up on the back end at a very reasonable pricing methodology with minimal interest. So not only can the pricing be more competitive on the universal life contract, but the client has the ability to continue coverage if he or she wishes, where all term policies have conversion expiration dates. If the carrier's generous, maybe you'll get to age 75, 5 years or age 75. Most companies in the marketplace are offering 5 years or age 70. If you enter into a permanent contract, you have the ability to catch up at any time, well beyond age 75 or 80 or 85. So the pricing factors are so significant that client may be even able to add an extended benefit care rider or a long-term care rider for no additional outlay. So I'll take you again through a client-friendly presentation. Here's a sample male age 70. Their current MetLife policy they purchased 20-year term 7 years ago. So you see $12,879 remains level premium through client's age 84. It's 13 years left on that level term period. Once you get beyond age 76, the convertibility is over. The annual renewable premium at the end of this level term period, you can see, jumps from $12,089 in year 14 to $228,000. Companies kind of got you right where they want you. So if you look at cumulative premiums through client's life expectancy under that scenario, you're looking at $1.2 million of total outlay versus entering into a universal life contract with Protective at a minimal premium to carry the contract for the same 13 years is $12,701. This contract actually had an extended care benefit rider and is also roundabout same exact premium, or a little bit less than the MetLife term policy. The difference here is that you can catch up at age 85 at a very reasonable $30,739, and you can step up every 5 years on a level basis. You look at cumulative premiums through life expectancy, it's a meek $288,000 compared to $1.2 million. So clients 65 and older, currently own term or looking to purchase term, take a peek at these guaranteed UL contracts with minimal cost of entry. Idea number 3, the 4-in-1 GUL. A lot of clients purchase guaranteed UL over the past several years. Most really perform only one task, and that's provide death benefit. In the contract I'm looking to share with you is a 4-in-1. So $1 actually works 4 different ways. You got guaranteed premium and guaranteed death benefit. You've been guaranteed indemnity-based dollar-for-dollar critical illness rider, which means if your client gets sick, they can take an advance off of the face amount in a dollar-for-dollar manner, no actuarial adjustment or penalty for doing so, up to the IRS per diem monthly amount, which today is $9,900 per month. So if you have a $1 million death benefit and you need 12 months of care, that's $118,000. Your family's left with the residual of $880,000. Number 3, guaranteed lifestyle access rider. This is what I call longevity insurance. For the first time ever, if the client doesn't get sick or die prematurely, they can put the entire death benefit into their checking account and spend it on anything they want while they're still alive. At age 85, clients can begin taking 10% of the face amount and spending it down to support their lifestyle. So, what does this mean? Clients can aggressively spend down their other assets because they know provides a backstop to do so. So they can not only necessarily live longer, they can live better. Fourth option is that after 20 years in this contract, the client's guaranteed 50% of their money back if they wanted to surrender. So, client-friendly presentation, $20,000 premium on a male age 60, preferred, $1 million death benefit. You can see at age the type is fairly small to get everything on one sheet, but what you can see here is at age 86, client can start taking 10% of the face amount while they're alive to support their lifestyle. So they have the ability to spend down their other assets from age 60 through age 85 because this benefit gives them the permission slip to do so. And oh, by the way, if they get sick along the way, they can take $118,800 off of the face amount for an 8.33 year period to exhaust the entire $1 million of death benefit. The IRS gave us clarity under Section 101G that states if a consumer cannot complete 2 of 6 activities of daily living, then the insurance carrier may accelerate the death benefit to take care of them while they are still alive. 4-in-1 guaranteed UL contract. That actually completes our Fast and Furious sales webinar. We'd like to invite you back to future webinars. We appreciate your participation, and at this time I can open up to any questions, or we can repeat any slides that you may have. But for the general session, the call is concluded.